I think if the Fed fund rates, if they do equate to lower interest rates, which again, it's not always that's not always the case, but if they do equate to lower interest rates, it could help shake the market out because it can help create clarity. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and I want to talk about what's going on in the markets. So with the Fed, Jerome Powell just announced that they're going to cut rates 25 bips, and they did. And so we now, over the last year, we haven't seen any movement, and so now we're seeing finally some movement. And so I want to talk about that. And they've also postured in the kind of what looks like to be maybe two, maybe three more cuts here coming. And how is that going to play into the general broader economy, and how is that going to play into real estate, I guess, is the real big question. So once the rates dropped, same thing happened, by the way, the last time, over a year ago when rates were dropped. What happened is the 5-year and the 10-year treasury actually went up. Same thing happened this time. The 5-year treasury, a 10-year treasury, I think was right around 4, maybe just a hair higher than that, and it went up after that was announced. So interest rates, which is what affects your mortgage rates, right? It's not the Fed fund, that's really the shorter end of the curve, right? But what really affects your mortgage rates is going to be how the U.S. Treasuries react to it. And so what we need to see is that to drop for mortgage rates to truly go down. And is that a good thing? Is that a bad thing? Is the Fed, what they're doing, a good thing or a bad thing? I think you can look at it both ways. One of the things that is always said is if interest rates are going down, if the Fed is cutting their rate, that means that the economy is likely not doing as well. And so if you look at it and go, well, they're cutting and that's great, we're celebrating now because they're cutting. Well, why are they cutting? They're likely cutting because they're seeing weaknesses in the market, right? Unemployment is going up. Is inflation going down? Not really. If inflation was going down, that would, I guess, be maybe a little bit more reason to celebrate, but it doesn't seem like that's truly happening. And so why are they cutting it? Is that really a good thing to cut? And so I want to talk through kind of what I see as far as that being a good or maybe a bad thing. And I'm going to more talk about real estate in general. So first of all, I think if, the Fed fund rates, if they do equate to lower interest rates, which again, that's not always the case, but if they do equate to lower interest rates, it could help shake the market out because it can help create clarity in the market. And I think actually, no matter what, with the Fed dropping, that does create some clarity that we aren't in a tightening position anymore, where that rates are likely not going up. Now, definitely things can happen, right? If all of a sudden inflation starts to spike again, I could see the Fed raising rates and reversing course. And all of a sudden, the U.S. Treasury is going up, and that could cause some major shakeup in the market. But as far as what we see right now and kind of the posturing is that the Fed fund rates will continue to come down, and that likely, not no guarantee, but that likely will lead to lower interest rates. If that does help, that'll help shake this market out, because what I'm seeing right now and what it feels like, and as I talk to brokers and as I just kind of think through what sellers' mentality is, including our own, is that, look, a broker's going to go to you and say, oh, market's doing great, you should list your property, here's what we can get to it for it. And if you think, oh, all right, let's try that, great. And so you're going to try to list the property, but if it doesn't sell for where you're at, you're just going to hold on to it. And so now this provides another opportunity for the brokers to come in and go, hey, interest rates are going down, cap rates are going to be compressing. We think, before we would have valued your property at 10 million, now we think it's worth 10.8 or whatever it might be. right? So you should list. And so I think it's going to shake more sellers out. I hope, quite frankly, as a buyer, I hope it does not raise prices, because here's what was the disconnect, in my opinion, in the first place, is that sellers' properties in 2022 at the peak of the market, 2021, 2022 at the peak of the market, were worth, let's call it, we had a building worth $10 million. Well, by this time, 2025, so I'm speaking end of September 2025, all of a sudden that value is no longer $10 million. Over the last couple of years, it's eroded, and we're talking like 8 million for that same property, maybe even less depending on the location and all kinds of stuff. So 7, 8 million bucks for that same property. And so as a seller, you're going, really? Do I really want to sell this property? Yes. The answer is yes, but I'm not willing to take that price. But if a broker can come to you and say, hey, we can get you 9, maybe you'll consider it. So interest rates, if they do go down, that helps us be able to increase our purchase price because our yields go up. However, we can't completely go up because there's already this disconnect, right? There's already this disconnect. We've either need prices to come down farther, or we've needed interest rates to come down to make deals work. I mean, we're striking out on almost every single deal. And honestly, that's always the case, I guess. But what I was just talking to somebody else, I feel like it's like 90%, maybe even more, of the buyers out there are actually being pretty conservative, are actually kind of right there with us. And then you've got that, 1 out of every 10 buyers, maybe it's even less than that, that they're aggressive and they're willing to pay whatever price it takes to get that property. And they almost seem like their money comes to them, I don't know, for free. I don't know what they're willing to do, how they're willing to pay. Some of these prices are outrageous in my opinion. Now some of them we're pretty close to, and we're just barely getting beat out, or a couple of deals we've won, right? But if you've got one of those buyers in that group and you're offering on it, forget it. They're going to win it at all costs, and they're willing to pay 20-30% more than you. But for the most part, there's this big disconnect. A lot of deals just aren't transacting. So if interest rates go down, it could be good for the market, could help shake things out, and it could allow us to buy more deals. Of course, that is assuming that prices don't go up. Lower interest rates also is going to allow for some of these deals to get refinanced that have been waiting, or maybe if prices do go up, to get sold where they can't sell. So it actually could help clean up some distress. Now, here's where I think it probably won't, is that a lot of the deals that are in distress are deals that were purchased when rates were at like, interest rates were at like 3%. So if all of a sudden interest rates go down and they're at, 4.5, 5%, that's still pretty far off of that 3%. So I think you're going to have to see a pretty significant drop in interest rates for that to make sense. And you're going to have to see the market go up pretty significantly for some of these deals. But it'll help shake a few deals, help get some deals refinanced. Actually, we've got a deal that we purchased in 2022, and we want to refinance it right now. But we kind of been waiting because is it worth it to refinance it? Proceed with the proceeds you're going to get. Well, if we can get a 50 basis points drop in mortgage rate, man, that really makes sense to refinance all of a sudden. So, that deal's it's not distressed. Everything's good. We don't have to refinance. We'd like to. But boy, I mean, if interest rates can drop by 50 basis points, now it makes a lot of sense. 100 basis points, yeah, well, of course we'd refinance. So there are those deals where you'll get some refinances done. And it'll also shake some single family stuff loose, which is a good thing. I think the single family market being healthy is good for the multifamily market to be healthy too. So it'll also shake some of those deals loose where now, as a seller, or a potential seller. There's a lot of people that are stuck in their homes and they want to get out. They don't like their house. They want to move. They want to upgrade. They want to downgrade. They just don't want to be in their house anymore, but they've got an interest rate that's really low. So boy, why would I sell and get rid of my, 3 or 4% interest rate and have to get into a 7% interest rate? Well, as interest rates go down, now it helps that gap and people feel better about selling. So I think it'll help shake that single family market out too, if it happens. Again, if it happens, just because Fed funds drop doesn't mean that interest rates will drop. Um, I think one of the risks here are it could potentially provide some future volatility. And so I think, you know, I don't see there being sudden rate drops, but if there are, sudden rate drops can, just can signal instability, can make lenders cautious. Again, why are we dropping rates? What are we seeing? So it can really tighten credit standards. Um, Spreads can expand. So if spreads expand, then all of a sudden interest rates, potentially go up or don't change at all. So we got this Fed fund rate that goes down, but we've got interest rates that stay the same or maybe even go up because there's more risk, perceived risk in the market. So I think, you know, that could that could create some challenges. The other volatility is that if the Fed fund rate goes down and if it stokes more investment and more purchases and all that kind of stuff, what could be a product out of that? Well, it's inflation. We've been fighting inflation now for the last 3 years. Well, if all of a sudden inflation starts to heat back up, like right now you got some coals um, on the fire. That's it. You don't got any logs burning. So you got some coals that they're but man, you put a dry log on there and some leaves, and all of a sudden we got an inflation fire again. So it could create some potential inflation, and we could potentially see expenses rise again faster than what we'd like. We could see rents rise faster than what we'd like, and even though we all want raising rents, we still rents going up too fast is not a good thing. So, um, at the same token, it could help stimulate economic growth. Cheaper credit helps businesses, encourages businesses to expand, and really could help increase demand for more office space, more retail space, more industrial space, more multifamily. So that's a good thing as long as it doesn't create inflation. So you want that happy medium, right? You want stimulated economic growth, but not to cause massive inflation, right? Inflation that gets out of control. Um, the other thing that I think, if interest rates go down, cheap debt can tempt people to make potentially poor investments. Have excessive leverage, really make themselves vulnerable. I think what's interesting too is that, will it create exuberance in the market? And so where people are like, hey, I'm gonna look at these rates are going to go down and they're going to put on floating rate debt, and because interest rates are just going to continue to go down, so I'm going to put on floating rate debt. And then all of a sudden, if inflation kicks up and the Fed has to reverse course and all of a sudden rates go back up, now you're stuck because you thought the trend was down, but the trend then turns back up. And I could easily see that happening. It's happened before in our history, and I could see it happening again. So the last thing is, lower rates could help stimulate new construction, which is definitely a good thing. It helps affordability. A lot of these markets, construction went from being at record highs to now being at record lows. In the Twin Cities here, we had 11,000, I think it was 11,000 units delivered in like 2024. And now in 2026, they're projected at like 2,800 units. So next to nothing. If interest rates can go down, that can help builders actually build and be able to hit their metrics to be successful. So that could stimulate that growth as well. So that's a good thing. All right. So last thing I want to talk about real quickly, I saw a post on I think it was LinkedIn or Facebook. Really interesting. And so there's it's called um, the Buffett rule. And so basically what it is that the U.S. GDP is typically about the same value as the stock market. And so when we look at the US GDP today, we're at about $30 trillion. So the stock market valuation should be about $30 trillion, be about 100%, but about the same. Somewhere within plus or minus 10% would be pretty healthy. Well, today, the stock market is sitting here and it's valued at $66 trillion, nearly $66 trillion. That is crazy. And when you think about that, that's 220%. 220%. I'll share this, my screen with you so you can kind of see. You can see here that we have this chart 220% of the GDP. And so, man, I mean, is the stock market majorly overvalued? I just talked to an investor the other day. He's like, look, I'm really happy with what's going on in the stock market. I'm going to keep my money there. And I'm like, hey, I don't want to persuade you one way or the other. I'm pretty nervous about what's going on in the stock market. I think it's overvalued, maybe ready for a crash, but certainly you got to do what's right for you and your family and that. But then when I see a chart like this, it's like, man, was I too nice about it? I should have maybe said, look, this is a scary place that the stock market's in. We are way above the mean. We are way above the Buffett line, right? And I know the stock market ebbs and flows, but this is a little ridiculous. And so I could see the stock market taking a major dive. You're talking we're over 100% off. So the stock market should really be the Dow Jones should really be valued at 43,000 and we're approaching 50,000. So anyways, just kind of I guess fun fact for the day, something to watch out for if you've got a lot of money in the stock market. I don't want to tell you to panic and go sell everything, but just think about what's going on with the economy. Think about the historics of the stock market and decide what's right for you and your investments. You gotta be able to make your own decisions, but it's just something to think about as you look at this chart. All right, that's all I have for today. You have a fantastic rest of the day. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.